Welcome back. Moving on to private equity, we shall examine some of the more common strategies related to private equity, the risk and return characteristics of private equity, and fee structure for PE funds. Let's jump in.
Private equity generally means investing in privately owned companies or in public companies with the intent to take them private. Private equities are usually categorized according to their investment strategy. They include leveraged buyouts, venture capital, and development capital. Leveraged buyout funds acquire established private companies or publicly listed companies with a significant percentage of the purchase price financed through debt. If the target is a publicly listed company, it is taken private after the buyout. There are two key criteria for a leveraged buyout to work. Firstly, the target firm should have the potential for increase in value through some combination of management incentives, restructuring, cost reduction, or revenue enhancement. Two types of LBOs are management buyouts, in which the existing management team is involved in the acquisition and will stay to implement the value-add measures, and management buy-ins, in which an external management team will replace the existing management team to implement the value-add measures on the target firm. The second criteria is debt managing to work out a highly leveraged purchase. If debt financing is unavailable or costly, LBOs are less likely to occur. The assets of the target company typically serve as the collateral for the debt, and the cash flows of the target company are expected to be sufficient to service the debt. If the buyout goes through, the debt becomes part of the capital structure of the target company. Another very common classification of private equity is venture capital. Venture capital funds invest in companies in the early stages of their development. The investment often is in the form of equity, but can be in convertible preferred shares or convertible debt. While the risk of failure is high, returns on successful companies can be very high. This is often the case when the company has grown to the point where it can be sold to the public via an IPO. The companies in which a venture capital fund is invested are referred to as its portfolio companies. Venture capital fund managers are closely involved in the development of portfolio companies, often sitting on their boards or filling key management roles. Categorization of venture capital investments is based on the company's stage of development. Terminology used to identify venture firm investment at different stages of the company's life includes the following. The formative stage refers to investments made during a firm's earliest period and comprises three distinct phases. Angel investing is capital provided at the idea stage. Funds may be used to transform the idea into a business plan and to assess market potential. The amount of financing at this stage is typically small and provided by individuals rather than by venture capital funds. Seed stage financing refers to investments made for product development, marketing, and market research. This is typically the stage during which venture capital funds make initial investments through ordinary or convertible preferred shares. Early stage financing is provided to companies moving toward operation, but before commercial production and sales have occurred. The investments are made to fund the initial production costs and sales expenses. Later stage refers to the stage where a company already has production and sales and is operating as a commercial entity. Investment funds provided at this stage are typically used for expansion of production and increasing sales through an expanded marketing campaign. Mezzanine stage financing refers to capital provided to an established company to prepare it for an IPO. It is the bridge between the expanding company and becoming a public listed company. Development capital, also called minority equity investing, earns profits from funding business growth or restructuring. Many times, minority equity investing is initiated and sought by management of companies who are interested in realizing earnings from selling a portion of their shares before they're able to go public. Although this scenario occurs most commonly with private companies, some publicly listed companies also seek this form of private equity capital. Such financing is referred to as private investment in public equities. And these are the common categories of private equity. Regardless of the strategy, the ultimate goal for a private equity fund is to improve new or underperforming businesses and exit them at high valuations in a time frame that averages 5 years. If the restructuring is successful, the private equity can sell the portfolio company in a number of ways. IPO is a well-known approach which involves selling all or some shares of the portfolio company to the public. Advantages include potential for the highest price, management approval since they are retained, publicity for the private equity firm, and future upside potential as the private equity firm may choose to remain a large shareholder. Disadvantages include high transaction costs paid to investment banks and lawyers, long lead times, high disclosure requirements, and potential lock-up period, which bars selling shares for a specified period. IPOs are usually only appropriate for larger companies with attractive growth profiles. If a company is not suitable for IPO, a viable alternative is to sell it through a trade sale, which is to sell to a strategic buyer such as a competitor. Benefits of a trade sale include lower transaction costs than an IPO, immediate cash exit for the private equity fund, lower levels of disclosure required, and potential for high valuation of the asset because strategic buyers may be willing to pay more. Disadvantages include possible lower price than in an IPO, possible opposition by management, lower attractiveness to employees of the portfolio company, and a limited number of potential trade buyers. Another form of sale similar to trade sales is secondary sales. Instead of a strategic buyer, this approach represents a sale to another private equity firm or other group of investors. If the portfolio company is not ready for sale yet, the private equity firm can extract some cash through recapitalization. Under this strategy, the company issues debt to fund a dividend distribution to equity holders, which includes the private equity fund. Recapitalization is not a true exit strategy, as the private equity firm maintains control. A recapitalization is often a prelude to a later exit. If the portfolio company fails to do well, the private equity firm may want to write off some assets to their fair value. The private equity may also liquidate the entire portfolio company and concentrate on other projects in its portfolio. These exit strategies that we have discussed may be pursued individually, combined together, or used for a partial exit strategy. For example, a private equity fund can sell a portion of a portfolio company to a competitor via a trade sale and then complete a secondary sale to another private equity firm for the remaining portion. Based on historical data, private equity funds have provided higher return opportunities relative to traditional investments. This can be attributed to their ability to invest in private companies, their influence on portfolio companies' operations, and their use of leverage. Besides, private equity returns have less than perfect correlation with those of traditional investments. So, like most other alternative investments, private equity funds can add diversification benefits to a traditional portfolio. The standard deviation of private equity returns has been higher than the standard deviation of traditional assets returns. This suggests higher risk when investing in private equity. While these characteristics seem to indicate that private equity is an ideal diversification asset, some critics seem, unconvinced. As with most other forms of alternative investments, private equity returns data may be overstated due to survivorship bias and backfill bias. Refer back to the first lesson for the explanations on these two biases. Besides, As the portfolio companies are revalued infrequently, reported correlations of returns and standard deviations of returns may both be biased downward. This implies that the diversification benefits are overstated and that PE funds are riskier than what's reported. Evidence suggests that choosing skilled fund managers is important. Differences between the returns to top quartile funds and bottom quartile funds are significant, and their performance rank shows persistence over time. Like hedge funds, private equity funds are typically structured as limited partnerships where outside investors are limited partners and the private equity firm, which may manage a number of funds, is the general partner. Most private equity firms charge both a management fee and an incentive fee. The management fees generally range from 1 to 3%, while the incentive fee is typically 20%. What's unique to private equity is this notion of committed capital. This is the amount that the LPs have agreed to provide to the private equity fund. The committed capital remains with the LPs until the private equity fund draws from it for investment opportunities that it has identified. Before the committed capital is fully drawn down, a process which typically takes 3 to 5 years, the management fee is based on committed capital, not invested capital.
So, for example, if the committed capital is $10 million and the GP has drawn $3 million to invest in a private equity deal, there will still be $7 million remaining in committed capital. Committed capital that has not yet been drawn down is referred to as dry powder. Be very clear that the management fee is calculated based on total committed capital of $10 million, even though not all the money has been invested. So, for example, if the management fee is 1%, the GPs will receive $100,000 fee each year. Do note this important distinction from hedge funds where management fees are based on assets under management. So let's say sometime later the GP entered into another private equity deal and draws down the remaining $7 million of committed capital to invest in it. Note that after the committed capital is fully invested, the management fees are paid only on the funds remaining in the investment vehicle. Note this word, remaining. As investments are exited, capital is paid back to the investors, and they no longer pay fees on that portion of their investment. So, for our example, let's say the GP first exited Deal A, the original capital of $3 million is returned to the LPs. From this point forward, management fee is only applicable to the remaining $7 million invested. Now that we're done with management fees, let us look at incentive fees, which we shall assume to be 20% for our example. In essence, the incentive fee is based on the profits booked from exiting investments. Do note that the incentive fee structure for private equity funds are sometimes subject to a hurdle rate, which we have covered under hedge funds. To keep our discussion here simple, we shall assume that there is no hurdle rate. A partnership's waterfall refers to the way in which profits from exiting deals are allocated to the GP and the LPs. There are two different systems, the American waterfall and European waterfall. Under an American waterfall arrangement, profits are distributed as each deal is exited and shared according to the partnership agreement. This is also known as a deal-by-deal waterfall. So from our example, let's say Deal A, which has invested capital of $3 million, was sold first at $4 million. The profit of $1 million is distributed on an 80-20 split based on the agreed 20% incentive fee. The GP receives $200,000 incentive fees from this deal, and the LP receives a distribution of $3.8 million. Let's say sometime later, Deal B was sold for $6.4 million. As the amount committed to the project was $7 million, there was a loss of $600,000. Since there was no profit made, the GP receives zero incentive fee from this deal. So in summary, for the entire PE fund, the total profit made was $400,000, and the GP took $200,000 in incentive fee. The incentive fee in aggregate is actually 50%, much higher than the 20% incentive fee specified in the partnership agreement. Now let's see how the European waterfall arrangement differs. Essentially, the incentive fee is determined based on the aggregate profit for the whole fund, not on a deal-by-deal basis. This is also called a whole-of-fund waterfall. So, based on 20% of the $400,000 profit, the incentive fee to the GP should only be $80,000. Implementation-wise, the LPs should receive all distributions until they have 100% of their initial investment plus the hurdle rate, if any. So for this case, the $4 million from Deal A should be fully distributed to the LPs first. Only the proceeds from Deal B should be distributed between the LP and GP to make sure the GP gets 20% of the aggregate profit from the fund. Each of the two arrangements have their own shortcomings. For the whole-of-fund waterfall arrangement, the GPs may not receive any incentive fee for a long time. For the deal-by-deal waterfall arrangement, we may end up with a case where the GP ends up with more incentive fees than is agreed on, as in this case. A clawback provision allows LPs the right to reclaim part of the GP's incentive fee if this scenario plays out. So, for this case, an LP that is subject to the deal-by-deal waterfall arrangement may be able to reclaim the extra $120,000 fee that the GP received from the first deal. And that concludes this lesson on private equity. In our next lesson, we will briefly touch on the other aspect of private capital, that is, private debt. See you again.